Hello and welcome to Nivesh Befikar, a joint series of Policy Bazaar and the Money Mile. Joining me today is perhaps the one person who understands the insurance sector like nobody else does. Someone I've known for many years, Amitabh Chaudhry, the Managing Director at HDFC Life. Thank you very much, Amitabh, for talking to us. I think there's so much to talk about, and I think the first thing I want to understand from you is that are the young people, the millennials as we call them, thinking very differently about insurance? Because I know we've spent a large number of years trying to convince people how insurance is as important, if not more, than actually just investing and building wealth. Is there a change? Are you seeing a shift?
No, I do completely agree with you that there is a distinct and a clear change which is visible now. We have always thought that the millennials are obviously more financially aware than the previous generations. They are obviously financially smarter. But we also thought that they were fickle-minded and they were very focused on here and now. And insurance is a product which might not fit into their overall scheme of things because it is not here and now. It is about investing and saving for the long term or planning your long-term financial goals. But I think I'm seeing a clear trend where the young aspirants, or the millennials as you call them, are worried about how do they take care of their long-term requirements. Please understand that with this rapid pace at which the world is moving, they're also realizing that we are acquiring some of these lifestyle diseases much faster than what we have done before. They are seeing some of their friends suffer unexpectedly. And I think that because, with all the social media and everything and how people are so well connected now, I think you get to know about people suffering or going through I would say a life kind of event very quickly, and it does hit you. So I think very clearly I'm seeing a trend where the millennials are really planning for the long term. It's a trend which has just started. I think it has to take off to a completely to a different orbit for it to become really large and big. But that trend is quite visible. So frankly, if you look at the number of people who are buying, and we are a very large player in the online space, a lot of young people are actually buying the products. Most of the people are actually
What's the kind of age group?
Below 35 years.
Below 35.
Which you would not expect.
Right.
You would expect slightly older people to be thinking about their goals, because when they start thinking of retirement. But actually it's the young people who are coming and buying the term insurance. Now obviously they want it here and now, so the experience they want in terms of the whole buying process or what they go through, they want it to be extremely efficient, and they want it to be single click, and that requires a lot of hard work. So the expectations are also very high, but they are there looking for these products and actually buying them, which is obviously great for this country, because you all know that India is underprotected. And it is underprotected by a huge margin. And what also has been seen when you frankly look at a country like China, that when a country reaches a certain GDP per capita, then actually the protection levels tend to take off. This is what we have seen in China in a big way. So when you look at the share of protection business in the overall premium income generated by the life insurance industry, it's abysmally low. And it can go to 4 to 5 times where it is.
What is it right now?
So
I know
it
we've
is
talked
less
about
than 5%
less than 5% when we first spoke. Has it gone up?
No, I don't think it has gone up. Now, for us it has gone up. We are now close to 25%.
No, I'm talking about the country.
I think it's below 5% even now. So, to be fair, you have to understand and recognize that the insurance industry has been growing quite rapidly over the last 4 years, and so has the population. So, even if the percentage remains the same, that means you're covering more people. So that's good, and you're covering new people, because what is getting captured in the 4 to 5% is a new business. If I bought a policy last year, I'm paying a regular premium. I'm not getting captured in that 4 to 5%. So new people are coming in, and they're coming to the extent of 4 or 5% every year in a growing environment. So that is good news. But it can become much bigger, should become much bigger. And I think when we hit that GDP per capita, I've heard numbers anywhere from $3,000 per capita to $10,000 per capita. I don't know in India when it will be applicable. But what is very obvious is we are underprotected. And when that hits, and when you hit that number, I think the protection numbers will take off exponentially.
Let's try and talk about various aspects. And we all think insurance is this one word and one policy, but there are so many parts of insurance. I want to talk about what you flagged off, and especially since you were one of the first who actually started identifying diseases. So typically we in the past used to go by this health policy, right? A reimbursement-oriented policy. We'll talk about that later. But you were one of the first who actually brought in disease-specific policies, and probably driven largely by the trend you started seeing of young people getting lifestyle diseases. Things like cancer, diabetes were not things you really looked at people in their 20s or 30s coming with. These were perceived as more old age diseases. What's your experience been with these kind of lifestyle diseases, and are you really seeing a trend where young people are getting conscious towards insurance, maybe first through health, and then maybe look at the other parts of it?
So yes, I mean, for us, when we launched the cancer care product, it was a runaway success. We were actually quite surprised as to how well it was received in the marketplace. And I think its success is very clearly demonstrated when you look at the number of cancer care products which are now there in the market. So obviously, not only we saw runaway success, but a lot of people thought that they'd want to capitalize on that trend. And now we have seen products around cardiac, now we have seen products around diabetes. I think some health companies have a product around dengue. And so, they have short-term products also where you can buy a dengue cover or chikungunya or some cover of that nature. That is one very clear trend that yes, people see a clear need for buying cover for themselves for some of the lifestyle diseases where the expenses can be astronomical, especially when you talk about some of the new cures which are coming. Some of these cures talk about a one-time spend of $500,000 to $1 million. And you don't want to leave any expense when you're talking about a lifestyle disease of this nature. So yes, I think people see the need. But I also see a second trend. The second trend which I see is that when they paid the premium for once or twice, I think this notion of invincibility starts coming in. No, this is not going to happen to me. Maybe it will happen to someone else. So I do see people drop off. Okay. Which is not a good trend. I think ultimately people have to see that you have to continue to pay for this, because when it comes and hits
so how does this work? I mean, when you say a cancer or a cardiac product, how does it work?
So it differs between a non-life and health kind of product and what life insurance companies offer, because the regulator has decided that we can offer only a product of a certain kind. For life insurance industry, it's very, very simple. If you have cancer, you as anyone who has cancer, then based on the kind of cancer you have, especially in our cancer care product, if it's a type 1 kind, we pay 25% of the money. We are not asking you what you do with it. We are saying we are giving you money to fight cancer. You fight it in your own way. If you have type 4 category kind of cancer, then we give 100% of the money. So we had sold it as a product where we allow you or enable you to fight cancer. The indemnity kind of products actually reimburse you for the expenses you incur.
And in fact, that's where the problem was, isn't it, Amitabh? Because people felt, and I'm not talking now, but I'm talking about many years ago, people felt that it's such a pain, to go there and then, you first foot the hospital bill, then go take the claim, then go pay. What you're really saying is what you've done is you buy yourself a product. If you get diagnosed, the money is paid to you.
Absolutely.
Now it's your problem how you want to spend it. You want to go to the US and get yourself the best treatment.
Absolutely, that's up to you. And we are not asking you that question. So it is a fixed payout kind of product. And that's how the life insurance industry has done it. So that's why you see the same thing in cardiac care. Now people are covering critical illnesses. And you will see more and more of this come, because obviously it is quite obvious that India, cardiac is a big issue, diabetes is a big issue. So I'm sure the innovation will continue to come in some of these areas. Now in cancer, it was simpler because, we didn't even ask for a medical, because almost you will not know today based on medical tests whether you will get cancer tomorrow. In case of cardiac and in case of diabetes kind of diseases, based on a medical condition, you can, predict more, I would say, logically, that yes, there is chances of you, having a cardiac problem or a diabetes problem in the future could be more. So yes, there you have to go through medicals, and your rate could be determined by what your current medical status or condition is. But still, I would expect more and more innovation to come. I mean, jokes apart, but the biggest or one of the largest selling products of this kind in Korea is nip and tuck kind of surgeries. The product itself is really the best there is when you go for whatever enhancement. If the surgery goes wrong, this product pays for your next surgery.
Wow.
And that's a large selling product because people, I guess, see the need for that kind of product.
Are you going to launch that?
No, nothing of that. But I'm just saying,
what's stopping you?
This fact is known to everyone. It's not that only we have got this fact. I don't know this fact. At some stage, I'm sure it will come in the market. In India, it is not seen as something which is done quite openly. So maybe when the millennials, talk about it quite openly.
So what's your next innovation? Give us a little peek.
Since you talked about innovation, I just remembered. Since we have got the approval and we are launching the product, let me talk about it. So, Annuity is a big market in India, and LIC has dominated the market forever. We also very clearly seeing that the corpus of NPS is growing quite rapidly. So this year we expect, based on the numbers which we hear from PFRDA, that about 120,000 crores will get added to the NPS corpus and will reach about 250,000 crores. Now, obviously, people as they buy NPS, more and more people will retire, and part of the money has to be used in buying annuities. So we believe that annuity is something which should be looking at. So we have come out with I will give you the simple publication of the product. It's called deferred annuity, where we are saying that, if you are 50, 55 years of age and you have some money today, why don't you lock in your interest rate today? So for example, if you're willing to defer your annuity by 5 to 10 years, you could get an uplift in the interest rates that you could get in an annuity anywhere from 3 to 5%.
Okay.
So you are locking in a rate today for anywhere between 9.5 to 12%, which starts post the deferral of the annuity, and it will be paid to you till the person dies, and then the premiums will be returned. And we also have an option where it will be paid till your wife dies, and then the premium will be returned to whoever you nominated the family. So
that's interesting, because 50-55 is typically around the time when someone has been able to build a certain amount of wealth and then is hunting around trying to figure out, how do I get a monthly component coming to me?
Absolutely. And he doesn't want to buy annuity today because maybe the rates he doesn't like. He says, oh, they are 7%. I don't like these rates, or actually 6.5%. But here is an opportunity for me to lock in rates at a much higher rate. Yes, you have to defer it. You're not going to get some money for some period of time, but you don't know what the rates would be, somewhere down the line. So we believe that, innovation like this is possible. We have worked with IRDA to convince them that there is a need for this product. I mean, it's not that we have innovated on the product. There are products like this available in the global market. But this is, I think, what HDFC Life has done consistently. We did with the online space, we did with cancer.
Let's talk about what is called pure insurance, right? Which is the term insurance. And again, historically, it's been a product which not too many people have bought, or rather, let's put it this way, not too many have sold because of the smaller ticket sizes, commissions, etc., etc. And yet, that is the one product which helps you to take care of your family in the event of you going in a substantial way. We'll talk about the investment side of it in just a bit, but have you started seeing, because the consumer behavior was that, oh, I get nothing in this. I pay this premium. The first question used to be, do I get anything? No, you don't. Oh, then it's not good for me. But has that changed? Because when you're talking of a 50 lakh, 1 crore cover, there are a lot of investors who write in saying my goal is 1 crore, 2 crore, 3 crore. So we Indians are thinking big with our life, especially the younger people. And the only way probably to get yourself a 2-3 CR kind of a cover in the event of you passing on would be through the term cover route. Has there been a change in people's thinking towards term cover? What's your experience there?
So the term cover, yes, there is a change. More and more people are buying it, as I said. You have to understand, when we say that protection has a 5%, let's say, market share in the overall new business, there are a lot of people who have bought term insurance in the past and continue to pay renewal premium, which is not captured in the 5%. So the 5% captures new people who are buying term insurance for the first time, or some people who are switching from one service provider to the other. I don't know what the numbers are, but I would presume that the new people are more than the people who are switching, who have kind of lapsed one policy and bought into another one. So yes, clearly the number of people who are getting covered now is increasing. Secondly, I think there are also companies who provide pretty decent amount of cover. For example, in HDFC Life, I have forced every employee to go and take a much higher cover than what a typical company policy would have allowed, and we are actually debiting that amount from their salary, and we have said no negotiation on this. And actually, as luck would have it, the number of deaths we have seen in HDFC Life this year is much higher than what we have seen in the past. So actually, because we don't go and reinsure it, we are actually incurring a much higher loss this year. But it's important. It's important to kind of get the notion out that at least in the insurance company, people should be well covered. As luck would have it, one of our senior people have just died yesterday in a road accident. So it is, I think, that notion which is getting very clearly into the people that yes, we have to take a higher cover, and yes, I think the number of people who are taking the cover is increasing. But as you rightly pointed out, people do want options. They just don't want a cover. In some cases, they want a cover for a much longer period. And now, for example, in our new 3D product, we have a cover which can go till the time of your death. So we are not kind of fixing a cap beyond which the cover is not available. Some people want a return of premium. So they say, okay, no, I have paid this money, but I want an option to get it back. Now, end of the day, people have to understand that, it's not done, it's not for free. Yeah. If you want a premium back, then I have to price my product also in such a way that I can afford to pay you the premium back.
Sure.
Because there are risks attached to it. I don't know how long a person would live. There is no way to hedge that kind of risk because the government paper which is available in the market is limited. So we do end up taking some reinvestment risk. So the pricing does differ. But I would suggest that people should go for a cover which suits their, as you said, financial goals. And you were talking to me as to how a lot of people are now writing into you about what their financial goals are and what they should do about it. And term cover has to be a integral part of it. Now, you take a term cover as a standalone product, or you take a term cover as a part of an insurance product, because every other insurance product also invariably has a term cover attached to it, does not matter. But term cover has to be taken, should be taken. And now the pricing in India, because of all the competition, has come to a point where I think it's very, very competitive. It is as competitive as any you'll find in the world. I think the whole process and the seamlessness which has been created in being able to buy a term cover of large amounts has increased manyfold over the last 4 or 5 years, because increasing competition has driven it. And you're seeing more and more innovation also in terms of what some of these term covers are. I mean, a couple of years back, there was no cover available which covered your life till you die. There was no cover available which was returning your premium. Now we have, for example, we have introduced it. Now some others have also talking about introducing it. So it's a perfect time to go and actually buy a term cover.
Let's talk about one piece that we've been talking about for many, many years now, the investment piece. Yes. Traditionally, we had endowment plans, the money back kinds, which is what connected with consumers, that, oh, I get something back. Then came the ULIP story. Started off well, but then there were concerns about very high charges, especially in the first year, all front-loaded. People didn't know that these charges exist, lock-in, and etc., etc., etc. But in the last few years, we've seen some very heavy regulatory intervention. And some of the products that we now see seem to be extremely low on cost. Would you say ULIPs have completely transformed from the time you probably launched your first one?
Oh yes, ULIPs have completely transformed. So when the regulator intervened in 2010 in a very big way, I think there was a huge step which they took. And the huge step which they took was that I will control what you can charge the customer. Now you in turn, Mr. Insurance Company or Mrs. Insurance Company, want to go and spend 5 times the money in acquiring that customer, your problem. Let your shareholders write the check. But the customer can be charged only that amount. Yes, so it had some clear features in it, which was there is a 5-year lock-in. The exit costs were made very, very low. The entry costs would also kind of became quite low. And as a period of time, as the companies gained scale, so initially when post 2010 when the products were launched, firstly a lot of people ran away from that product because they couldn't afford to be selling that product at the kind of cost structures they had. But gradually over a period of time, as companies like us gained scale, you very rightly, as you pointed out, we are not charging what is the maximum allowed to us by the regulator. The charges have come down, and when you compare now today a life insurance to a mutual fund product, it is extremely competitive. As long as you have a slightly longer term horizon, because in an insurance product you are locked in for a period of 5 years, and mutual fund you can get out whenever you want. Now frankly, if you go and analyze the mutual fund portfolios, I read a report which said that 1/3 of the retail portfolios in mutual funds are actually not even there for more than a year. So people are actually investing in and getting out within a period of 1 year.
Churning it.
So they're churning it. So maybe that's a product for them. But there is, in your overall financial goals or a financial asset, there has to be a portion of money for investment purposes or savings purposes, which you want to keep away for at least 5 years. Now, the moment if you have that money you want to keep away for 5 years, today I would say ULIP products are even more competitive than that of mutual funds on the equity side. Another advantage people forget in case of insurance product versus a mutual fund product is, mutual fund, when you switch, you're almost like buying a new product. In case of insurance, invariably these ULIP products have 8 or 9 funds within them, including debt, equity. You can switch as many times as you want. The cost of switching is very low. You can redirect your premium. So there's a lot of options available. So you continue to get the tax benefit. You remain in the same product, and the charges on that particular product are much lower than over a longer term horizon than what you would see in a mutual fund. Over and above that, when you look at the performance of, say, a typical insurance fund or a mutual fund, the differences are not that much. They're pretty similar. I mean, you can always find a mutual fund which has performed better. I'm sure you can find an insurance fund which can perform better. But if you have a long-term horizon and you're willing to keep your money invested for a period of 5 years and beyond, today ULIP products are more competitive. At least some of the ULIP products which are out there are much more competitive than that of what you'll find in a mutual fund. And I think it puts pressure on mutual funds also to continue to price themselves well. And I'm sure it will, like a feedback mechanism, put pressure on the insurance industries to again reprice the products and bring the prices down. And it helps the customer overall because your price of buying into equity or debt markets is reducing over a period of time, which is great for the customer. So, yes.
So it used to always be said, and I'm probably sure it's true even today, that insurance is never bought, it's sold. Am I right? So how have you then changed the dynamic? Because if a large part of your charges were actually going in commissions to acquire customers, would you say the game changer has been digital, online? Because otherwise, how do you incentivize the same person who you were incentivizing in a certain way 5 years ago or 10 years ago to now say, look, I can't give you this much, but you still got to go and sell my product. So how's the industry managed this?
So it's a journey. First is that there is still a very large part of the population which needs to be touched. We need to have face-to-face discussions with them and convince them that there is a need to have a part of your financial assets in products like this. So I don't think for an insurance company to survive in the long term, you can do away with a distribution or distribution channels or a distribution system which allows you to touch the customer on a face-to-face basis a couple of times. Because there are enough customers out there who need to be educated, who like a face-to-face discussion and want to be convinced, etc. But yes, gradually, slowly, as the products are dumbed down and they become more and more commoditized, or the offerings are well understood, like, for example, in case of mutual funds now, even though, as you were rightly telling me, people have invested in too many mutual funds, and I think they don't understand what that mutual fund does, but assuming, we're just taking it out for a minute, as the products get dumbed down, yes, more and more people will come online, and more people will either buy, since Policy Bazaar is working with you, people like Policy Bazaar, or come directly to our website because they trust the brand and they might be buying directly from us because they believe that yes, it's a great company offering the right product and I want to be invested with them. So that trend of buying more online will increase. Now, when will it take off, as I said to you? I don't know, but people are getting more and more comfortable. So first is, people were told that ULIP products are not good and they're being missold. Now slowly, gradually, I think a lot of people are understanding, no, there is a set of ULIP products which are great actually. And the size of the population which understands this will gradually increase. Now, as they keep talking to each other and as the notion around ULIP changes, that it is as good or even better than a mutual fund product, as long as you have a long-term horizon, I think more and more people will come online because the product is well understood. There are almost no charges to the product. So you don't have to be worried. You know what I'm going to be charged. Don't worry about what is happening in the background. My charges are almost lesser than the mutual fund. I know I'm locked in for a period of 5 years. Yes, if I'm a savvy investor, I have the right to switch if I want. And if I'm locked in for 5 years, I'll hopefully, if the markets do well, I'll get a good return. And that's what you have to be worried about. And by the way, it comes with a term cover also attached to it. And my maturity proceeds are all tax-free. So as long as that is understood, I think people can very easily go online and start buying these products, which is, I think it's only a matter of time before that happens.
My final question, Amitabh, many people think buying insurance is a jhamela. I'll be asked for medical checks, I'll have to go contact an agent, find the right agent, there'll be paperwork. Again, you were one of the first who went online and said that, look, if you go digital, we'll make the experience very easy for you, a good experience for you. How different is it? Both in terms of ease, speed, complications, cost, if I were to choose to buy my policy online?
So let's start with the first one. If you go and buy a policy online, the costs are lower. And actually, regulator has played an important role here because they said that since there is no intermediary involved, why are you not pricing it lower than what you normally are pricing for your other distribution channels? So the prices are lower, point number one. For example, we have launched a combination product with Apollo Munich. The prices of that product are even lower than what our online product are. If you buy both of them together, there's a 5% discount. So that's first part. Secondly, yes, all of us have worked very, very hard to make the process as seamless and as quick as possible. We don't want the customers to be going through a medical if the medical is not required. So for up to a certain amount, most of the companies have what they call limited underwriting or no underwriting. In some cases, nothing is required. In some cases, you have to answer some basic questions and no medical is required. And now some cases, we do a telephonic kind of, medical. And yes, in some cases, we'll even send the person to the home to get your medical done. But in some cases, it's a complicated case, especially if you're older. For people like us, I think you have to go through a medical. And that can't be avoided because you're looking for maybe for a slightly large cover and we cannot take the risk. But the whole purpose of this is to understand that we're trying to make life simpler. Please understand, since we were the first ones to this space, we also saw a huge amount of fraud. And obviously that made us a bit wary about making it so easy that it becomes even a green channel for the fraudsters. Please understand that for a product like this, if you invest a small amount of money, you can get the best investment return possible in the shortest period of time. You pay 10,000 rupees and can get a 1 crore cover. I mean, how great an investment can be. So on one side we want to make it easy for the right kind of customers. On the other side we want to make it very tough for the fraudsters. So, over a period of time, we've also brought in a lot of algorithmic kind of analysis which we have done and ensured that we are picking out the potential fraudsters who could be misusing this whole seamless process which you have created to go and buy a product online and then, say someone has died and claim the money. So yes, online is more seamless, it's faster, it's cheaper, and I think this trend will continue because from our perspective, the more people they come online, cheaper it is for us. And obviously we are attracting a very different set of customer because if they're coming online, I don't have to sell to them. Voluntarily they're coming online. It's a great customer to have because the customer is feeling the need for a term cover. And invariably these customers stay around longer, so the persistency is better. The quality of the lives because people are doing it because they're doing a long-term planning, the quality of life is better because they care about their life. So from every which perspective, if the right customer is coming online, it's good for the insurance industry. So we'll do whatever it takes to do that.
It's been a pleasure talking
Thank
to you.
you.
Thank you very much for joining me.